The Ensemble podcast is intended for professional financial advisors. All discussion is limited to publicly available information and should not be interpreted as legal, professional, or financial advice. Ensemble does not hold an AFS license nor provide any financial services. Before making investment decisions, you should obtain financial advice from a qualified financial advisor.
Hi everyone, it's Neil Rogan here from Russell, and today I'm joined by Alex Cousley, who's a Senior Portfolio Manager also here at Russell. And today we're here to talk about what's been happening in the economy. Alex, welcome. I noticed that in the US, earnings are up and we have volatility in the oil price, and usually these two items aren't actually correlated. Do you want to talk about the earnings season in the US and maybe the earnings season in Australia and what that means for markets as well as geopolitical conflict?
Yeah, absolutely. So I think the best way to summarize the US earnings season has been phenomenal. It's been way above expectations. To give you a sense, we came into the earnings season with the market thinking we'd see about 12 to 13% earnings growth. And as we sit here today, it's closer to 28. So it's a huge beat. It isn't just AI, so the AI names have done well, but it's also been consumer side, industrials, materials, energy obviously has had quite a nice earnings season. And what's really encouraging, I think, is that you've seen margins expand. So profit margins have been on a steady upward climb, and they've moved again higher through the quarter. And I think there's two parts to that. Firstly, the wage side of the equation has been cooling still, so we've seen wage pressure declining. And the second is AI is clearly starting to show up a little bit in terms of how companies are using it. We've been through 2 years of experimentation, and now we're starting to see some real use cases of it. And so I think it's a pretty nice setup from a corporate earnings side that when we look ahead, we think that the margin story is still supportive. And the revenue line is still going to be supportive as long as the economy holds up, which is our base case.
Mm-hmm. And so what does that mean for markets more generally? Is there going to be a recession in the US? Are we headed for a recession in Australia?
Yeah, it's a good question. So for the start of the US, we don't think recession risk has moved since the start of the year. So we were coming down through the second half of last year in recession risk. We got to 20%, which is kind of close to normal. There's been a lot of vigorous debate with the Iran conflict. But as we sit here today, we think that as long as the oil price is below about $120 a barrel, you don't have to worry too much about recession risk. So we think we're in a decent spot with the economy. The longer it goes on, it becomes a bit more challenging because we know that lower income consumers and middle income consumers are feeling the pinch from oil prices and gas prices, but they've got some savings, they've got tax offsets to help them through. In Australia, we think the number's a little bit higher in terms of recession risk. We don't think the RBA have reached the point of policy mistake, but if they're to raise rates 2 more times, as a rough rule of thumb, we're probably looking at closer to like 40 to 45% recession risk in Australia. If they do those.
So do you just want to talk about, unpack Australia a little bit for us? So we go US, low recession risk, but Australia, we'll just say a 40% chance. And can you unpack the interest rate rises as well?
Yeah, so the 40% is if the RBA raise rates 2 more times, which the market has been flirting with the idea. The interest rate rises since the start of the year have really been about inflation being higher than what the RBA was comfortable with and then having to push out their forecasts. I think we've started to see already signs that the economy is cooling. So consumer confidence, business confidence, the housing market, sales this weekend after the federal budget were softer. Okay. They're all moving in a softer direction. So I don't think the RBA have to go to 2 rate rises. But if they do, then I think you're looking at a materially higher recession risk. It kind of flows through to corporate earnings as well. Like the US earnings season has been great. Emerging markets has been pretty good. Europe's been okay. Japan's been really good. Australia's been pretty lackluster.
Yeah.
And we think that's going to continue with that structural overhang of higher interest rates, a little bit of inflation pressure, and the fact that Australia is more exposed to oil prices than the US is.
And what about productivity in Australia?
Yeah, this is one that has been a challenge for some time. And it's not just Australia. The US is very, very good on productivity and Australia is quite bad. I think we are still some way from seeing much improvement. There was a lot of excitement with the budget that maybe this would be a productivity budget. It wasn't really. There's some changes to taxation. I don't know how much productivity improvement that we'll see. And so I think we're probably stuck for the next 12 months in a fairly lackluster productivity environment. And the bottom line for that is that the economy can only grow a certain amount before you start seeing some inflationary pressures pick up. And so you're kind of locked into a softer growth environment until we get that unlock of productivity, which, at this point is kind of hard to see what will drive that.
Okay. Just switching gears for a moment. China, we had the US president in China last week. And what do we think, firstly, about Chinese economy? Where's it at vis-a-vis the rest of the world? And what should we be looking out for there?
Yeah, so on the Chinese economy, it's pretty tepid. If you take a step back, China has been trying to go from capital intensive to consumer intensive economy for 5 years. It hasn't been very successful in that yet. And they're kind of leaning back to the old playbook of industrial stimulus. So we're looking at kind of a 4.5% to 5% GDP growth rate for the next year or two, we think, which is fine for the for the global economy. It's okay. It means that demand is still going to be there. Where the detachment is Chinese earnings have actually been quite good. And so that story that we've talked about before, probably the last podcast, of Chinese companies becoming more like Western companies in the way they deal with shareholders, that's continued. So we aren't seeing issuance picking up. So there's no dilution of earnings. And so we think that the Chinese corporate side should deliver relatively decent earnings this year.
And then maybe in the last couple of minutes, anything on the UK and Europe?
Yeah, so on the UK, there is a lot of political noise right now. Keir Starmer doesn't look like he's going to last particularly long. UK gilt yields, so bond yields, are starting to look very cheap on our valuation models. Our global fixed income team are looking quite close at whether there's a tactical opportunity to add some gilt yields. I think whilst there's this political uncertainty around who's going to be the next leader or the potential leader of the Labour Party, there's been quite a bit of volatility there. And then in Europe, we were quite positive last year on the European cycle. We were seeing credit lending picking up. Those things have kind of abated a little bit, and you have the added challenge of energy. So the outlook for Europe has kind of subsided a little bit compared to where it was before the Iran conflict kicked off.
So to wrap it all up, a client comes in and says, well, what's happening in the world? What do I tell them?
Yeah, it changes it's quite quickly moving at the moment. But I think the first one is the global economy is proving quite resilient right now in the face of higher oil prices. The second is corporate earnings, especially in the US, have been very strong. Companies are managing this quite well and making quite a bit of money. The third is interest rates around the world have been normalizing back higher, which from a investor perspective, it gives you a more attractive yield to start. And I think the final one is in Australia, probably one more rate rise to come from the RBA. That's manageable. I think if we see the RBA pushing towards 2 rate hikes, I think the economy is going to see a more meaningful slowdown.
Okay. So watch for that rate rise. And if there's another one. Okay. Well, thank you, Alex. As always, enlightening. And, you've given, hopefully, our listeners to date plenty of talking points that they can talk to their clients about when they come in and ask what's happening in the economy. So thanks for your time, and look forward to catching up again.
Thanks, Neil.